Portfolio construction extends beyond selecting attractive investments and managing risk. It must also account for the implicit costs associated with implementing and maintaining investment positions. While explicit costs such as commissions and fees are readily observable, implicit costs are often more difficult to quantify and can materially reduce portfolio performance. These costs include bid-ask spreads, market impact, opportunity costs, and price slippage resulting from trading activity. Active managers must recognize that every portfolio decision carries implementation consequences that affect realized returns. Consequently, portfolio construction should incorporate cost awareness from the outset, balancing expected alpha against the expenses required to establish, maintain, and adjust portfolio positions over time. Transaction costs represent one of the most significant challenges in active portfolio management. A manager may identify a security with attractive expected returns, but excessive trading costs can erode or even eliminate the anticipated benefit. Large trades often move market prices, creating market impact costs that increase execution expenses. Less liquid securities may have wider bid-ask spreads and limited trading volume, making transactions more expensive and difficult to execute efficiently. Portfolio managers must therefore evaluate whether expected excess returns are sufficient to justify trading activity. Incorporating transaction cost estimates into portfolio optimization allows managers to pursue opportunities that generate meaningful net alpha after accounting for implementation expenses and execution challenges. Portfolio turnover is closely linked to implicit costs and serves as a critical consideration in construction decisions. High turnover strategies frequently buy and sell securities in response to changing forecasts, creating greater transaction costs and increasing the likelihood of performance drag. Although rapid portfolio adjustments may capture short-term opportunities, excessive turnover can diminish realized returns. Conversely, low turnover strategies generally benefit from lower implementation costs and reduced tax consequences but may respond more slowly to new information. Effective portfolio construction requires balancing responsiveness to evolving market conditions against the costs of frequent trading. Managers must determine whether incremental gains from portfolio adjustments exceed the associated execution and operational expenses. Liquidity considerations also play a vital role in determining portfolio structure. The liquidity of an investment influences the speed and cost with which positions can be established or exited. Securities with limited liquidity often require managers to accept price concessions when trading, increasing market impact and reducing realized returns. As assets under management grow, liquidity constraints become increasingly important because larger portfolios may struggle to acquire or dispose of positions efficiently. Portfolio managers must therefore align position sizes with available market liquidity and ensure that the portfolio can be rebalanced effectively without incurring excessive costs. Failure to account for liquidity risks can impair flexibility and hinder performance. Another important implicit cost arises from capacity constraints. Every investment strategy has a practical limit to the amount of capital it can manage before performance begins to deteriorate. As assets under management increase, managers may face difficulties maintaining desired position sizes, executing trades efficiently, and accessing smaller investment opportunities. Capacity limitations can force managers to diversify into less attractive securities or accept greater trading costs. Portfolio construction should therefore consider the relationship between strategy capacity and available capital. Successful managers recognize that maximizing assets under management does not always maximize investor outcomes and may take steps to preserve the effectiveness of their investment process. The concept of a well-constructed portfolio extends beyond maximizing expected return. A well-designed portfolio reflects the manager's investment philosophy, incorporates high-conviction ideas, maintains appropriate diversification, and controls risk exposures. It balances expected alpha with practical considerations such as liquidity, transaction costs, turnover, and implementation feasibility. Portfolio construction should ensure that individual positions contribute meaningfully to overall objectives and that no unintended exposures dominate performance. The portfolio should also remain consistent with client mandates, regulatory requirements, and benchmark constraints. Ultimately, successful portfolio construction integrates both quantitative analysis and practical implementation considerations into a coherent and disciplined investment framework. A well-constructed portfolio effectively aligns risk with conviction. High-conviction ideas generally warrant larger allocations, but position sizing must also reflect uncertainty, liquidity, and diversification requirements. Managers should avoid excessive concentration in individual securities, sectors, or factors unless supported by strong evidence and consistent with the investment mandate. Risk controls help ensure that portfolio performance is driven primarily by intended investment decisions rather than unintended exposures. Furthermore, diversification should not simply involve increasing the number of holdings but should focus on combining investments whose risks and return drivers complement one another. Thoughtful risk allocation enhances the portfolio's ability to achieve superior long-term risk-adjusted returns. Ultimately, topic emphasize that successful portfolio construction requires integrating investment insight with implementation discipline. Superior security selection alone is insufficient if transaction costs, liquidity constraints, and operational inefficiencies erode returns. The well-constructed portfolio balances alpha generation, risk management, diversification, and cost control while remaining aligned with the manager's philosophy and client objectives. By carefully considering implicit costs, capacity limitations, turnover, liquidity, and risk exposures, managers can improve the efficiency with which investment ideas are translated into portfolio performance. This holistic approach increases the likelihood that expected alpha becomes realized alpha and supports sustainable long-term investment success.